Imagine owning a tiny piece of the biggest companies on Earth and getting paid while you sleep. That is what buying a stock actually means. And once you understand it, investing stops feeling like gambling. Most people think the stock market is a casino for the rich. It is not. It is the single most reliable wealth-building machine ordinary people have ever had access to. You just need to understand the rules. Here is what is at stake. Money sitting in a regular savings account quietly loses value to inflation every year. Money invested in stocks has historically grown faster than almost anything else. Doing nothing has a cost. So what is a stock really? A stock is a tiny piece of ownership in a company. Buy one share of a business, and you literally own a slice of it, profits and all. When you own shares, you are a shareholder. If the company grows and becomes more valuable, your slice becomes more valuable too. You are now an owner, not just a worker trading hours for cash. Why do companies sell stock in the first place? To raise money. Instead of borrowing from a bank, a company sells pieces of itself to the public to fund growth, hire people, and build new things. The first time a company sells shares to the public is called an IPO, an initial public offering. After that, those shares trade between regular investors like you, all day long on a stock exchange. Now the part you care about. How do you actually make money? There are two ways, and smart investors use both. The first is price growth. You buy a share at one price, the company grows over time, and the share becomes worth more. Sell it later for more than you paid, and the difference is your profit. The second is dividends. Many established companies pay out a slice of their profits to shareholders, usually every few months. It is like getting a small paycheck just for owning the stock. Real money while you sleep. But prices do not just go up, they bounce around every single day. Why? Because a stock price is simply what people are willing to pay for it right now. When more people want to buy a stock than sell it, the price rises. When more want to sell, it falls. It is supply and demand, driven by how investors feel about the company's future. Good news, like strong profits, pushes a price up. Bad news pushes it down. In the short term, this looks random and emotional. In the long term, real business growth is what wins. And here is the most important idea in this entire video. The stock market goes up and down constantly in the short term, but over the long term, it has trended powerfully upward. Take the S&P 500, a basket of 500 of America's biggest companies. Over many decades, it has returned roughly 10% per year on average. Not every year, but averaged over the long run. That long-run average is the floor of your wealth-building plan. Reinvest those gains, and compounding takes over. Your returns start earning returns, and your money can snowball into something life-changing. Real proof. Someone who invested steadily in a simple index fund for the last few decades, through every crash and recovery, would have turned modest monthly amounts into a serious nest egg. Time did the heavy lifting. So why does anyone lose money? Usually, one big mistake. They try to pick the perfect individual stock, or they panic and sell the moment the market drops. Picking single winning stocks is incredibly hard. Even professionals struggle to do it consistently. Bet everything on one company, and if it fails, so does your money. That is closer to gambling. Here is the beginner-proof solution. Instead of betting on one company, you buy a tiny piece of hundreds of them at once, through something called an index fund. An index fund automatically holds a whole basket of stocks, like that entire S&P 500. One simple purchase, and you instantly own a slice of America's biggest companies. Built-in diversification, almost no effort. If one company stumbles, the others carry you. You are no longer betting on a single horse, you are betting on the entire economy slowly growing over time. Historically, that is a far safer bet. Okay, so how do you actually start? Step 1. Open a brokerage account. It is an account that lets you buy and sell investments, and opening one online takes about as long as making a social media profile. Step 2. Link your bank and add money. Step 3. Buy shares of a low-cost index fund. That is genuinely it. You are now an investor and a part owner of hundreds of companies, and you do not need to be rich to start. Thanks to fractional shares, you can buy a sliver of a stock with as little as a few dollars. The barrier to entry has never been lower. Now the single habit that beats almost everyone. Invest the same amount on a regular schedule, every single month, no matter what the market is doing. This is called dollar cost averaging. When prices are high, your money buys a little. When prices are low, that same money buys more, automatically. You stop trying to guess the perfect moment and you let consistency do the work. This one habit removes emotion, the thing that destroys most investors. You are not watching headlines and panicking. You are calmly buying a piece of the future every month, like clockwork. You have probably heard, time in the market beats timing the market. It is true. The investors who win are not the smartest, they are the most patient. They start early and they do not stop. Crashes will happen, they always have. But historically, the market has recovered from every single one and gone on to new highs. A crash, to a long-term investor, is just stocks on sale. One thing to watch: fees. Some funds quietly charge high fees that eat your returns over decades. Stick with low-cost index funds and keep more of your money working for you. Also, be smart with taxes. In many retirement accounts, your investments can grow without being taxed along the way, which supercharges your compounding. Use those accounts first whenever you can. Let us make it real. Picture investing a few $100s a month into a simple index fund, starting young, and just leaving it alone for 30 years. Through booms and busts, that steady habit, powered by roughly historical average returns and compounding, could realistically grow into hundreds of thousands of dollars. Not from picking winners, from time, consistency, and patience. Let us recap. A stock is part ownership of a company. You make money through price growth and dividends. Prices swing short-term, but the market has trended up over the long term. Do not gamble on single stocks. Buy low-cost index funds for instant diversification. Invest the same amount every month, ignore the noise, and let compounding work for years. That is the whole game. The hardest part is not understanding stocks. You just did that. The hardest part is starting and then staying calm. But you now know more than most people ever will about building real wealth. So do not let this just be another video you watched. Open that account this week. Start small if you have to. Future you will be deeply grateful that today you finally began. Now I want to hear from you. What is the one thing about the stock market that always confused you? Drop your question in the comments below and I will help you out. And if this finally made the stock market make sense, hit that like button, subscribe for more simple money lessons, and share it with someone who needs to start investing. Let us build wealth together.